Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Our next investor conference is less than 3 months away. The Planet MicroCap Showcase Vancouver is coming up on September 6th and 7th, 2023 at the Fairmont Waterfront. Be sure to check out a recent episode that I did with Paul Andriola, founder of Small Cap Discoveries and lead sponsor of our event. To learn more, to register and attend, please go to planetmicrocapshowcase.com. See you in Vancouver. I got a full panel today for this episode. Andrew Walker, host of the Yet Another Value podcast, Jason Hirschman, managing director of Hudson 215 Capital, and Maj Soueidan, founder of geoinvesting.com. Last year, when we did the mid-year review, we all needed a nice glass of whiskey to drown our sorrows in the bloodbath of 2022 for microcaps. 2023 has been slightly kinder. All major indices have been up on the year, and as per usual, small microcaps have lagged. I invited on my esteemed colleagues to talk about all of this and more. By the way, Ryan Irvin was supposed to jump on this for the pod, but we had a little bit of a tech issue, so he'll be back on in a few weeks. So thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Andrew Walker, Jason Hirschman, and Maj Soueidan. Gentlemen, thank you for joining me today. How you doing?
Doing great. Thanks for having me.
Very cool. I mean, like I said, just not as bloody as last year. I don't think everybody is feeling like that death wound of microcaps as 2022 was, but it seems to still small caps still seem to be lagging everything else as per usual in times like these. But I want to start us off with everyone's kind of initial takes on this half year that was of 2023, and your microcap small cap investing experience thus far and what you've seen. So to kick us off, how about Andrew? Come on, we talk all the day on the pods. I'm always seeing what's going on there. So let's get your take first.
Yeah, look, it's tough. Every day you wake up and if you look at CNBC or something, they'll be like indices at new highs. And I'm with you. It feels like small caps last year, especially in the May timeframe, was probably the most depressed that I've ever felt when talking to other investors. The depression was just tangible. I talked to a few small cap guys who were like, hey, maybe I need to hang this up. This is just, it's too brutal doing this. I certainly don't feel that this year. But, unless you've got something with a real techie, buzzy play, it's probably just flat on the year. It's been, it's been tough. It's still tough to generate a lot of alpha. I still feel like there's a lot of value out there. A lot of stocks that are, a lot of my companies, they report numbers. I'm like, oh, these guys are performing really well. And then I look at the stock price. It's like, okay, the stock is up 50 basis points. And, if you zoom out 3 months, the stock's down 10%. And I feel like they're doing better than normal. So yeah, look, companies keep humming along. Everybody's worried about commercial real estate. Everybody's worried about recessions. The companies I look at, they're doing just fine. They've got great balance sheets. So in general, I feel like it's a pretty nice time to be a stock picker, even if the near-term results kind of aren't showing that.
100%. We'll dig into a lot of that too. Actually, some of the questions that we got in from Twitter are hitting on a lot of that stuff as well. So Maj, you were in Vegas, you did some moderated Q&As that were pretty awesome. You talked to management teams, nonstop. I mean, what's kind of your take? What's the tenor in speaking with some of these management teams as well?
Well, I mean, yeah, I'll touch on that part and I'll also touch on how I feel, about the market in general. But from talking to a lot of companies, we interview a lot of companies at Geo before we bring them on the platform. We read a lot of conference call transcripts, and the one thing that was interesting is those companies that are not doing so hot operationally, are basically blaming more I don't want to call it a recession, but uncertainty on the B2B type of relationships. So customers, maybe aren't filling their inventory or as quick as they used to, and because of uncertainty. So I just want to throw that out there. I don't think they're seeing necessarily a recession, in the consumer side, consumers, but there's a lot of uncertainty on the B2B side of it, which makes it a little bit challenging when you're talking to companies, because the consumer might still be strong, but the companies might not be kind of, anticipating that they continue, and so are basically, not really preparing for as much growth. So I found that to be interesting. And so if we do avoid a recession or something, it's gonna be pretty cool to see how that comes back. And then in terms of the market in general, we're in this really, I've been tweeting about it a lot and talking about it for a while now, maybe over since 2022, that this reminds me, a lot of the .com kind of bubble thing and the crash where during that time, and it's funny, William O'Neill had the same kind of perspective on this too, about talking about .com, like his strategy of GARP and momentum and value wasn't really working that hot back then. Or I don't want to say GARP, but he was definitely an earnings kind of a driven strategy with momentum. It kind of took a back seat during the .com kind of bubble, and then when it burst, it became very popular again, I guess, according to him. And I remember going through that myself. I had a lot of GARP-ish type of stocks, and I also owned some .com stuff and made some money in that whole thing, but it was outperforming my value kind of or GARP-ish stuff. Then when we had the .com bubble, those stocks did just wonderfully for many, many years. And I think what we had here is a 15-year .com bubble in terms of like easy money, speculative stuff going up. We know that sales growth more important than earnings growth, high multiples, because you could afford to do that. You could afford to grow revenue and subsidize your losses or lack of profitability by just borrowing cheap money or doing offerings at any price you wanted to do with that. Well, that's changed now. You can't, monies are free, and the market knows the companies that are going to be in trouble. So you have this, I think, interesting going on where you have this slow bleed in companies not making money or not profitable, bad balance sheets. And they don't have to be like bad balance sheets. If you're not making money, you're going to start being valued on your earnings. I'm not saying across the board, everyone, but yeah, in general, I'm seeing that. And then I'm also seeing this really, really awesome performance by stocks that are actually back to that GARP-ish thing. So if you actually are a stock picker right now, using these traditional valuation metrics as and momentum, what I'm finding is momentum plus GARP plus finding stocks in the meat of a growth cycle or catalyst is working really, really well. And while you have the slow bleed of the market going on in these other kind of stocks, a lot of the slow bleed is happening in the nano-cap area. I mean, this is where a lot of that kind of froth happened, right? A lot of great, sexy stories with nothing behind on earnings. And so we get frustrated and blame, why is the nano-cap market doing so bad? Well, it's because there's a lot of shitty companies in the market cap space. And that they comprise a lot of that in the indexes that are out there, right? And so we're seeing that slowly kind of dissipate, but underneath that current is really, really, really good stuff going on. So I ran like a model portfolio in another product we can talk about some other time, Bobby, outside Geo. But I've been testing it about a year and a half now. It's all based on GARP momentum and picking these nano cap companies. I'm looking at under 500 million market cap, but they generally fall in the under 100 million situation between North America, basically U.S. and Canada, meeting some strict requirements on valuation and these growth requirements. And it's like it's 60 stocks, doing nothing. It's I have cliff notes, but they're up like 20% just by being stupid, just put them in there, versus that time frame where the microcap indexes are barely up or even down big. It's beating. It's crushing the indexes across the board, and I think it's all the other indexes are up at most 5%, and even some are down. So that's telling me that that's kind of working again, this momentum plus GARP approach, using kind of Peter Lynch's principles. So I think that there's opportunity here, a lot of it. And now I'm not talking long term, I'm talking these short term pockets. How do you, in some of these do term and long term plays, 70% of those companies have been up 20% at least. And that's just really, and that's just the low end because they were a lot higher. So there is this opportunity now, and I'm really excited about it. I'm upset that I don't own a lot of them. I still got stuck with this. I still had that legacy shit that I bought, from a few years ago.
Still hanging in like full illiquid land, like.
So I'm watching my slow bleed, right? Like, all right, well, and that was one of the. I think, like, when do you sell the shit, right? That might be do good in 3, 4, 5 years. When you trade it in for this
all your subs right now are taking notes, like, okay, what does he mean by sell the shit? Let me see.
Yeah.
He's been having these same top fives for the last like 3 years. Like, which one is he talking about right now? Oh, that's too funny, dude.
That's kind of my perspective. I think we're just in this. I think we're in a really interesting bull market current for boring traditional GARP stocks going through, really good growth cycles.
For sure. A lot to go down there as well. Want to get Jason's take, and then we'll get into some of this too.
Sure. And I think my take may be sort of a variation of Andrew's take in the sense that, we're looking at these the NASDAQ, right, almost making new highs. And then you look at your Russell 2000 or your microcap indices far away, from any kind of new highs, and certainly sort of underperforming this year. So, last year was I think painful for a lot of microcap investors, but this year is sort of a different kind of pain because you see other parts of the market sort of performing well, and some of your stocks or your area of the market is not performing as well. I think the one thing that does sort of concern me is that is it not necessarily that like a lot of microcap or Russell 2000 stocks are really undervalued, but a lot of like tech stuff is like maybe simply overvalued. And if you look, there's less statistics for like microcaps, right, than like say the Russell 2000. But right now at the end of 2022, I think 40% of the Russell 2000 was consisted of like unprofitable, like negative earnings stock. While you go back to like 2007, right before 2008, it was close to 20%. You go back to 1999, 1998, it was close to 15%. So if we enter a more normalized interest rate market, we enter a situation where, raising new capital, whether on the debt side or the equity side, is more expensive. Given that so many of these some smaller stocks are unprofitable, it makes me very concerned about, purchasing unprofitable companies that don't have a very clear path to profitability. And I think all of us on these podcasts always sort of stress the importance of profitability, but I think that's like doubly important, maybe even going forward.
That kind of hits on one of the things that I've had many conversations with over the last 6 months with, various IR firms and management teams and fellow investors, just, that a lot of them have said, dang, wish I raised capital 2 years ago, cause now they're in a place where, or at that time they're like, oh man, we're in green. Our investors are so happy, this could, it's just that folly of thinking like this could go on forever. And then here you go, and that's not to say that, every company needed to, but the ones where like you could have looked out and been like, hey, you know what, where our price is at right now, we could have used some of this to, for times like these when all these other prices are depressed, or you might be able to get something, maybe a tuck-in acquisition at a discount of what you could have, 2 years ago. It would be nice to have that dry powder. But I don't know, that's been one of the things that's been a very ongoing conversation happening right now, especially now when you consider how capital is much more expensive than it was.
Well, just the guys who are supposed to be experts at this, aside from us, I guess, are bank managers.
Definitely
right?
not me. You guys, not me. No,
bank managers are supposed to be really great at this. And just look at all these banks, like, First Republic, right? Last year, First Republic is buying back shares, and, they're getting, it's a bank. Your assets are pretty liquid, or even if they're loans, like you can value them pretty easily. If they ignore all the marks on their book, like they were still trading at 2 times that book, they're buying back shares. All these guys are buying back shares. And this year, when times are dire, First Republic is gone. They obviously wish they had held that capital. There are so many banks you see that last year they're buying back their stock, and this year all of them are saying, hey, we can't buy back stock. They're probably secretly, they wish they could get a capital raise off Silicon Valley. Like, and that a lot of companies, maybe not the small microcap because liquidity tends to prevent buybacks, but there are a lot of companies that when times were really good in late 2021, they were buying shares, and today their stock prices are 60, 70% lower. They're not buying back shares. So they were buying back shares when times are good. They're not doing it now. And with the benefit of hindsight, as you're saying, they kind of wish, hey, I had that capital. I might need to do a capital raise now. I bought at 100 and I might need to sell some stock at 30 now.
Maj, you were about to jump in too.
Yeah, I think this whole, and like Andrew made a good dissecting between the smaller cap and the large cap regarding capital raises. I mean, from our perspective, I don't know, you too, Jason, you see this all, I mean, there was a lot of capital raising going on in the small cap space before this all imploded. The issue really isn't that. The issue is shitty companies were raising, a lot of them were raising money. So these are the same shitty companies right now telling you, I wish I would have raised money back then. Well, you still be shitty now. You're not, the focus should, the answer should have been, I should have been focused on making fucking money and having a business plan that made money. And that's the issue. They're blaming the market now. They just have shitty fucking plans. They can't make any money. And that's what it comes down to. And, this hypersensitive focus now on profitability seems like a new thing to us, but it's really what investing was all about, like for years. It just got lost. And, you have these IR firms and, pitching shitty companies. You have a really weak IPO market in the last several years. For 30 years, I haven't seen this bad. You're better off being private as a better company than going public half the time. So we're just not getting this great pool of smaller companies. That's the issue. The issue is lower quality companies coming public, and a lot of these newer companies not thinking about profitability. And I think that's what I've seen, and I find myself buying
they always thought they could push profitability down the line, and there was always a new set of shareholders or existing shareholders willing to give them more money. Right. So, and for a long time it worked, but then it doesn't. And then what?
Right.
So that's a real issue.
And that's the whole thing where you're going to start seeing this like really kind of switching. A lot of stocks I'm buying now are these older companies that have been around 20 years ago that have survived all these markets. And now people want them now because they actually make money, And I think that the focus from investors, find these companies don't have to raise money that can actually just do a lot of that can grow organically, and that will be able to raise money because they can command it. They have the right balance sheet, they have the right growth plan. Good companies can go raise money right now, and it might not be at the best favorable terms they can do. I'm talking in the smaller cap space, but it's certainly harder. But as investors, we need to, I think our first thing is, does this company have to raise money to grow? And if it does, we gotta, we gotta look into that a little bit, right?
Maj is in prime form this morning.
I'm pissed.
I'm freaking loving it, dude. Like, this is what I'm talking about. This is why we have Maj on the pod. Is for takes like this. But I mean, but you're right. I mean, there's everything that. It's funny because, depending on the investor, when I'm doing some of these interviews, you'll have some people that are like, I'm like a kid in the candy store. You're seeing companies that are trading, 50, 60% of what their highs in 2021. And there's still, parts there that are interesting that could ultimately be problem. But at the end of the day, that's the case. Like, there should just be a focus on profitability, especially in the microcap space. But, one other question that I had for all of you, because we talk, more generally of our takes and all that and what we just kind of covered here. But I mean, has there been any notable resurgences or notable collapse or disappointments in this first half of 2023? You don't have to name companies in particular, but we could talk about sector, anything like that you've observed thus far in this first half. Andrew, I'll come to you first on this one, and let Maj and Jason think of maybe a couple others that are out there.
I don't know about noticeable sector collapses. I guess the most interesting sector to me right now is banking. I think there are a lot of banks that 6 months ago would have fallen into the small or mid cap sector that now are in the micro cap or small cap sector just because their stocks have been cut in half and people are terrified of the banks. And, in March and April, I was pretty nervous, but now I kind of look at it and I think Silicon Valley, First Republic, the other guys, like, those were mismanaged banks that were one-offs. Their issues were not systemic. They were one-off. And I think a lot of these banks, I can point to a lot of community banks that are kind of trading for half of book value that, just did. I don't know how familiar listeners are with demutualizations and stuff, but they're because they just did a demutualization, which is basically an IPO. People can think of it. They did an IPO and raised a ton of capital in 2022. So because of that, they're trading at half of book value, and most of their book value is just cash. They're just way overcapitalized. And the history of demutualizations is you demutualize, and in 3 to 5 years, you sell yourself, and your executives get really rich because they took a part of the company down in the demutualization. So I just think there are a lot of banks that are really interesting where a lot of them are getting painted with a broad brush of, hey, we're having a banking crisis, we're going to go into a recession. It's like, it's generally not the thing. People have been talking about commercial real estate for 18 months. It's generally not something that you talk about for 18 months that brings banks down. It's generally like a really unexpected thing that just hits them in the face. So I think you're buying really well capitalized banks at half a book, and I think it's a big opportunity. So that wasn't a absolute collapse, but that's just where my mind has been and where I was going to take my section of the podcast anyway.
I was just going to say, we've covered banks quite a bit on your pod. You've had quite a few guests talking about that, and it's been every single one has been. I've learned more about banks in the last 6 months from your podcast, I think, than I ever thought I would. That's for sure. Jason, you want to take it?
No, it's interesting because I had an account with I still do actually with Western Alliance, which one of the banks that really got smashed.
Yeah.
But in some sense, I also have an account with with one of the big Wells Fargo, right? And within seconds, though, as a depositor, you're like, why should I keep any money over that limit? And I didn't have to go to the bank. I didn't have to even talk to anybody. I just pressed the button and just transferred the money. So there is a little bit with that now risk, right? Because it's so easy now to shift money around when it was, 20 something years ago. However, I will say that I think below that regional bank, you have so many of these really small community banks where there's such a stronger connection between their customers and the bank, as opposed to even at the regional bank level, that I don't think it really applies. But everyone's just so many people just say, anything below the big four banks or just you can't stay in them, and that's totally not true.
Well, so as retail depositors, I'm with you. It would be crazy for a retail depositor to have to over $250,000 in any bank.
Yes.
But a lot of these banks, so a lot of the community banks, especially, their franchise is built on retail depositors with under $250,000. A lot of these guys say, hey, our average depositor has 30, 40,000, and that's great. But there is something to people get really freaked out about deposits over 250,000. It's true. You shouldn't. But if you're a business, right, a lot of these are operating accounts, and you just can't have 500,000 operating accounts under 250,000. You can't have your operating account where you're pulling it into a money market fund every day. Some of these chunky accounts are it's a 20 million account because it's a $1 billion business and they have to make payroll every day or all these other stuff. So there is a reason to have them, but I'm with you. It is easier. You look at Silicon Valley Bank losing literally tens of billions of deposits overnight. If you rewound as quickly as 2008, there would have been lines out the door across the street. You simply couldn't pull that much money from a bank because you had to go have a teller give you a check, deposit it, physically get the check, cash and all that. That was the only way to do it. Banks do need to think about liquidity and all this sort of stuff going forward. But look, if you're under $250,000, there's absolutely no need to move it, even if
absolutely,
the bank gets distressed. So these tend to be sleepy accounts once they have them, and it's really nice funding. Our cost of capital is probably higher than, even with interest rates going up, it's probably higher than the banks. They're paying 2% on their deposits. We've got a lot higher cost of capital than that. They can fund a lot of stuff pretty profitably.
And one other thing I will mention is that I think you also see maybe in the beginning, first half of this year, the final thrust of some of these COVID champions sort of getting walloped, right? And Liat is a name that I think was very popular on Twitter, right? And just get hit because their sales just drop off a cliff. Partly because it's one of those industries where just too much inventory moved up into stores. And it's funny to see some of these names, which everybody loved a year or so ago. Everyone piles onto it for 3 or 4 days, and then everyone just forgets about it. And still, is it a terrible business now long term? Is it or is it? Yeah, okay, it may not be as great as people think it was, But sometimes there's these opportunities now looking at some of these COVID plays that as now sales are actually better than and the inventory is coming down. So sooner or later that will even out. And then hopefully the stock will perform at some point in time, and the company will grow earnings. So I think there's opportunities in some of these COVID darlings to that turn into hellholes that just may rise from the ashes.
The asses, yeah, that too.
Asses, right from the asses.
Right. Jason, real quick.
Yeah, I'm just thinking like
yeah, I got it. Hey, Jason, real quick, are you a shareholder in Liat?
I am now. Yes.
I always mess it up. Is Liat? I always mess up that.
Whatever. It's you've been with a New Yorker or LA. You call it Liat, you call it Liat, right?
Yeah.
So
one day I'm gonna get management on the pod. I've been that's been a golden goose for the last year.
Right. And part of the other thing is sometimes these management teams, especially with microcaps, they don't explain when something goes. They don't like to give too much detail about the business, right? So in Liat's case, right, it seems like it suddenly went to hell, right? But we're probably going to find out in another 6 months or 9 months. It wasn't that situation at all. It's just that they, for whatever reason, didn't want to sort of let the market know that things were slowing down or they had inventory issues and things like that. So sometimes it's just tiny little companies don't do a great job of explaining themselves or disclosing, but you can take advantage of that if you sort of reach out to them or just look at the numbers a little more closely.
Well, no, Jason, it's the classic case of hey, I'm a small company. When bad news is convenient, you just try and take advantage of that and hide. Yes. Right? And then when a great quarter, it's why are more people paying attention? So it's almost like a convenience factor once, when things are going bad. And then when things are going great, it's just wait, why are more people? It's well, you should have probably been communicating in both times so that people are, for better or worse, following at least.
But there's a natural human tendency just to.
Sure. No doubt. There's no denying
that.
Right. But you should be talking about it. Come on the podcast. Yeah. Let's talk about it.
Come on. Yeah, exactly. At least go on their podcast, for goodness sake. Go on the podcast.
It'll be fun. Maj, what do you got?
I full disclosure, I don't own Liat, and I said 5 minutes before the big run from 3 to 30. Literally, it was my bottom ticked it, but wish I would have had it. I think Jason makes a good point here in terms of you can find right now some of these, the COVID example he gave is a great example. There's these stocks that had real businesses. They made more, and they found a way to make money from the COVID, scenario. But the base business, now we got to look at the base business. They're cycling up against those comparisons, so they don't look as good, even though the underlying business might be growing a little bit. But they're going up against those COVID revenues. So I don't know how long it takes, for those comps to start looking good. But sometimes the valuation gets good enough where it's gonna be worth waiting for that growth, the cycle now, right? So, making that list of stocks that got killed during COVID would be, I think, is a great plan. The other thing you can look at, I think, I don't really follow sectors too much, Bobby. So I just can tell you maybe the AI one's going to implode one day. We all know that probably, but on the nanocap side. But I think what I'm looking at too is trying to find these companies that are getting crushed right now during earnings season because they got blindsided or something happened there. Maybe their debt's the interest rates going up, and their interest expense line. They didn't see it coming, and they're going to make changes, and they're just getting crushed. And you'll see some stocks in earnings time getting crushed 50-60%, out of the blue. It's crazy for even the slightest miss. And making that list of those stocks that have fallen sharply that you think are going to come out of this, is really a great opportunity. And you see a lot of that in nanocap land. And I think there's a lot of actually stocks with significant revenue that are traded as nanocaps. They're not just. And those are the ones I'm looking at, these really seasoned companies just getting killed and making quick moves to restructure, that tweak a little bit. So, a year and a half from now, the numbers will look a lot better, but we're buying it now. So it really prices you won't see again. So you're seeing these mini crashes in some of these good quality companies, not just the ones that aren't doing good because they missed a quarter or two. And I think that's a bucket I'm kind of, really making a big list for right now.
That's been kind of one of the going trends also I've been hearing too. This actually leads into one question, not necessarily, when a company has, one quarter miss necessarily, but, I put out that you guys are coming on the podcast and to solicit some good questions, and got a few of them. So the first one came in from Luke Walgram. At Luke Walgram, Jason, he was on the Europe panel. Yeah.
Yes, he was.
And Luke asked, how does one deal with multi-year drawdown, sideways movement on a stock when a company is making underlying progress, but the stock is going nowhere? Do you wait it out? Do you move on at some point? I think that's a pretty interesting question, because have been some companies that have been, continuing to progress, announce a good contract wins, having a decent quarter, not losing money, and so I think that's actually a really good topic. I mean, who wants to take a stab at it first? Jason, from my view, I'm going to go counterclockwise. So Jason, I'll go you first and then we'll go to Andrew.
Yeah. I mean, I think, it's always a challenge, right? I mean, it's part of the problem is like investing is not like Netflix, where like if you're just bored with the show for like after 30 seconds, you just switch on to a next one and then another one and another one, right? So sometimes there could be moments when clearly the stock price is ahead of the fundamentals. And then the question is like, well, how long does it take to backfill the fundamentals, right? And then you can, and you have the classic situation of Buffett with Coca-Cola, where, I mean, it got very high priced and it took a very long time for it to backfill. Or after the 2000 crash, you have, great companies like Walmart, which just got such high valuations. It takes so long to backfill that if you just bought it right before then, your overall return is not, it's not too high. So, I mean, there's so many factors that go into a situation like this. And partly is, what kind of tolerance you have for just, moving sideways. Some people get bored, and there's nothing wrong with just taking some of it, a little bit off the table. What kinds of concentration, what's your tax basis, all of that comes into play. But when I go back to just the main thesis, which is that, look, use the Peter Lynch, test. Like, where are we? Where's the stock? Is it the third inning, or is it like the seventh inning? If it's the seventh inning of a stock, then you probably don't want to give it that much time, right? If you think it's more likely that this is the third inning and there's so many more rounds to play, in a great growth company, then I think you have to give it a lot of rope. But it's an art and a science.
Very good, Andrew.
I like how Jason was asked how you respond to multi-year drawdowns, and Jason's first instinct was go to, what happens when you buy a stock and it gets really overvalued really quickly? I enjoyed that. Look, I mean, it's hard. I think the longer you do this, the more you think, there's not much edge to be had on the research side. Like there have been people who have gotten really good scuttlebutt checks or physical checks or stuff, but those are very few and far between, in my opinion. I think the longer you do this, the more you realize a lot of this is a psychological game, and dealing with big drawdowns and dealing with big drawdowns is one of the tough things. And another of the tough things is like, look, good theses, there are a lot of them out there. What really matters is doing the work to have conviction in the thesis, so that when the stock price is down 10, 20, 30%, if you don't have the conviction, a lot of times you'll sell it into that, it'll be down 30% on bad numbers and say, oh, this is a disaster, and you sell. Or it'll be down 30% on bad numbers and you'll say, oh, this is a buying opportunity, you buy. And if you've done the work, the right answer is, oh, this is an absolute disaster, I need to get out now before things come. So yeah, I think it's just over time doing the psychological things, being able to deal with them, doing good work so that, hey, the portfolio is down 50%, but actually the portfolio is in a much better place than it's ever been. It's time to maybe deploy some cash or sell some of the things that are down 50 to buy some of the things that are down 70. Or, another thing is, I personally was very guilty of this in 2021. A few of my positions got to, if I thought they were worth $100 per share 5 years from now, they kind of, as Jason said, they were in the seventh inning and they were trading at 95. And I was kind of like, oh, my tax basis is 30. I don't want to sell because I think it's worth 1,000 5 years or 100 5 years from now, and I don't want to take the tax hit. So let's kind of take a sub-average IRR just to hold on to this thing. But as Jason was saying, they're in the seventh innings. It's not like there's huge growth. Like, I'm kind of just milking the last few things. Being convicted enough in your work to say, hey, I can sell this. I can take the taxes suck. I do need to think about the after-tax consequences, but I can sell this and go find the next great thing, or, just hold some cash for a while, that type of stuff.
Very good. Maj?
Yeah, I think I just, both Jason and Andrew made some great points there. I know, and Andrew's point there regarding, guys, if you have a discipline, keep it. I'm guilty for the same thing. I'm holding stocks well past their expiration date, probably in 21, because you get emotional, and then what do you do? Then as they come down, if you didn't sell them, and you have a harder emotional decision. So I think number one is to really continue to understand why you bought a stock, and if it's reached some of your price target goals, or like Jason said, if you're in the later innings of the growth, make some decisions at that point and stick to them. Don't second guess them. But yeah, I think it's one of the hardest things that any investor goes through, really, is waiting. How long do you wait? And I had to wait 15 years for one of my stocks to make a move. But if I would have held it just for the last 3 years, it would have been the best. So I wasted 12 years there, right? So it's not easy. So the way I like to do it is just when I have a portfolio, if I have the long-term portfolio, I'm just content with. I've understood that I like this company a lot. I'm just going to wait until it happens. If I still think it's undervalued, have conviction, I don't care about the price volatility. And having that self-discipline, if it goes up, to have these maybe sell targets potentially. But I like to have my side pocket short-term stuff. I'm not talking like day trading, but still based on fundamentals, stocks that I can at least psychologically make money on to feel good that I'm making money in some shorter-term stuff, whether it's 6 months or 9 months or 3 months, that based on some fundamental value. I might not love it long-term, but I might like it for a 50% move in the short run. So trying to have that combination where, for me, it was, if I can make some money in the short run on some great fundamental type of strategies, I can psychologically, hold the longer term stuff a little bit. So that's how I kind of handled it. But there is that situation when you run in that uncomfortable zone where you have a stock you've held for a long time, you're just not quite sure yet. You're not quite sure if they're ever going to come through, and I don't have an answer for it, because I know when I was younger, and what worked for me, if I didn't like a stock, if I had any answer, I would just sell it. I would take my loss, move on, because I know there's 20,000 stocks out there, 10,000 MicroCap stocks. I'm always going to find something, and I've always felt when I've done that, it's like, I felt this relief. It's like breaking up with somebody. You've been going out for a long time. It's harder thinking about it, but then doing it, right? So once you do it and you go back, all right, well, there's always going to be opportunity. That's the way I look at it. So if it's causing you so much mental stress where it's keeping you from actually progressing in your portfolio in total, it might be good to start at least peeling some off and start having some success somewhere else. Or if you have them, maybe it's not a problem. No, you can hold long term. You don't even care about it at all. I think some of the greatest investors have the ability to tune it all out and not even care. This is my position. I don't care if it takes 1 year. I don't care if people are making 30% of theirs. I'm making nothing, as long as in year 10, I'm going to the thing's going to catalyze so big. So it's really a personal kind of decision, I think, and that's how I deal with it, though. So.
Bobby, if I could just add one more thing, the great growth stocks, and not just in microcaps, but sort of larger companies too, right? And they spend so much of their life well off the 52-week high, right, or all-time high. And so if the expectation is, I think, among some investors, that your stock should always, the great companies are always at a high, and that's not true at all. On the other hand, though, like the mediocre stocks are also spend a lot of times off their high. Right. So the challenge is always to figure out, is this a great company or not a great company? And what inning it is. And then if you understand that, then all this other stuff is just small potato stuff.
100%. I wanted to, by the way, I have no comment for everything that you guys just said. Everything. One, I think Maj made what you closed out with there is that it's all an individual pursuit. It's really big. Ian talks about this all the time when he puts out his tweets about, investing is very much tied to your personality in many respects. So it's just a matter of, this is your own personal journey, and how you handle that is really up to you and what you feel most comfortable with. But I wanted to move on to another topic. And this wasn't a question from Twitter, but it was something I thought of in getting prepped for today. And, you could always make the argument that micro and nano cap investing is just special situation investing in general, right? I mean, in many respects, but it seems like in the last 6 months, there's been more of these kind of special situation-y type situations or ideas coming up. I mean, Andrew on the pod, Vate and Cutter or Kutera, QTR. Just speaking of that, I mean, I don't know if you guys have seen more of some of these things happening right now, especially as some of these companies are either restructuring, going through strategic reviews, strategic alternatives, trying to figure things out. But I mean, Andrew, I know you're talking with quite a few of these investors to come on the pod to talk about some of these things, because some of those investors have been in the name for a while, are now getting interested because there's some of this weird, hairy stuff going on. I'd love to hear your take if there is more of that right now.
I think there is probably a little bit more. And I think what happens is when times are really, really good and money is just free, or when times are really, really bad, it forces companies, and money's really expensive and nobody can raise any capital. Those are the two times where it forces a lot of special situations, because when times are really good, you'll just have all these crazy bids and you'll have wild overbidding for companies and that type of stuff, because they can issue equity at 100 times sales or something, or they can go raise. And so you'll have crazy bidding wars. Or when times are awful, you have companies that look and they say, hey, I've got debt coming due, I've got expensive capital, all this sort of stuff. Investors are really going to hold my feet to the fire. So times are bad, so they have to do these things. I think those just are the two real catalysts for a lot of events to pop up. And I think that's why over the past few months, companies are coming out and they're saying, hey, in 2021, we were selling people on, we're going to sell 200,000 EVs in 2023. And then in 2023, they say, oh, actually, we haven't manufactured a single EV. This is a disaster. And you've seen some of these companies file for bankruptcy. You've seen some of these companies liquidate. Maybe there's some mergers. But yeah, those are the type of things that I think spawn these special situations where companies' backs are just to the wall and they've got to do something.
Maj?
Yeah, I think right now, and to piggyback on Andrew, what he's saying there, if you're a small situation investor, you're in a candy store right now, potentially. I mean, because companies are forced right now, they're forced to do things, and whatever you want to call us, debt restructuring, spinoffs, going through Chapter 11, this is a great time to be looking for some of those opportunities. We have this thing, like MicroCaps are always in kind of restructuring, right? When they're always doing things. It's funny. I was just thinking about that. And you can always put that tag on the stock you're looking at. But I know that we went to the .com thing. You had all the telecoms, just 70%. They all just got crushed, right? But there was an awesome opportunity coming out of that to buy all these Chapter 11 companies. And coming out of that whole thing, I mean, I was investing in some of them. My first stock I ever bought was a Chapter 11 exit, actually, when I was young. So I think. So we're going to see a lot of those. I know Rich, the spinoff thing, he's probably going to have a wonderful time finding things here right now.
Yeah.
But yeah, I think, you're going to see a lot of type of restructurings come out of this kind of mess we're in right now, because companies have to become leaner and better at what they do, sell operations to raise money, and which is going to be good for us. I think we're going to start seeing maybe some really nice opportunity from a lot of this. And I'm particularly looking at the Chapter 11 space. I'm hoping that gives us some opportunity to buy some nice Chapter 11 exits and some, Monster Beverage, number one stock of the century, was actually a Chapter 11 exit when it was a private company. So, Charter Communications, top, 3-5 cable company, was a Chapter 11 company out of the 08 recession at some point. I think 14 it went Chapter 11. Spectrum Brands. The list goes on and on. So if there is one side of the special situation, I'm looking at those Chapter 11 situations, and those are restructuring their balance sheets or selling off divisions to become better companies. So, but I'm pretty excited about it, and I think that's going to be a wonderful trend for several years to come.
Wow, I'm so glad I brought this up as a topic to talk about. I wasn't even planning on it. This is great. All right, Maj, hey, real quick, are you a shareholder in any of the names that you just mentioned?
Unfortunately, I'm not a shareholder in Monster. I sold it a long, long time ago when I made 20%, or maybe a double or something.
That was one of those. Sorry.
So my first job out of college was Monster, was at JP Morgan. And I remember a very high up executive for Monster, came to the office and was talking, and they were like, we were the best performing stock over the past 10 years. And somebody joke, and the guy took it the wrong way. It was like, listen, if you had bought Monster 10 years ago, you wouldn't even be working here. Like you'd be retired on the beach because of the best performance stock. And I remember thinking that and I was like, man, this guy's arrogant. And you know what? If we had just bought Monster then, I think the stock's done so well over the past 10 years, you could probably still make the same joke.
Yeah, that's so true.
Wow.
I remember that was what was funny about this funny story about the Monster was I just started like I was full time for a couple years or whatever, and or maybe I'm sorry, maybe 6-7 years, and came across Monster. I remember because I was drinking in a college one day, and I remember Peter Lynch buy what you know, and I saw Hans it was HANS, and I was all right, cool, Hans, and now I'm Monster. So I was training somebody. I used to give one-on-one courses when I was young. And I said, hey, why don't you interview this Pounds Beverage, see what's going on there, and he went and interviewed him. And he goes, yeah, they're doing this thing, some energy drink called Monster. They don't know if it's going to be really big or not. Yeah, it might take off. They're not really sure. So I sold the stock. That was my experience with Monster. But I remember back then, it's like thinking, wow, that was I just didn't see it coming. But the lesson I learned there was do the interview yourself, and that's what I should have done.
The lesson learned there is like, why didn't I buy Celsius like 8 years ago? Like,
oh, that was even that. I just couldn't do Celsius, man. That was tough. Amazing run that one's had.
It really has, that one's so tough because I would go even though my wife's sitting behind me, she hates it. I really like energy drinks and I tried to cut down, but I've been very aware, like every gym I would go to would have Celsius in them. And you want to talk about a company with red flags. Like there was a lot of related party dealings and I knew the product. And I think that's just a case of if you were going to the stores and you could just like turn off your investor brain, actually, it would have been one of the few cases where it was like, don't read the 10K. Don't read anything. Just go to the store and see how many people are taking these things off the shelves and just buy the stock purely on that. And you would have done so well.
It tasted good. I thought Celsius tasted great. And it was a good product. I thought,
it's a good product.
Yeah.
I don't know how you differentiate between any of the energy drinks. To be honest, I've got a NoCo container on my thing because I like the cross. So I'll hit them if they want to give me a sponsorship. Come back. But
shake them up.
They're all kind of the same, but it is a habit forming thing, right? Like once you start drinking one, and once you get the distribution, and you're inside the CrossFit things, and you're really associating with it, but. Yeah, man, that thing's done well.
I don't know, dude. Nothing.
The red flags are ridiculous on that one. I just
Eastern European. I believe there might have been an Eastern European mafia angle. I know there was Eastern European related party dealings. Woo.
Yeah. Dilutive offerings in the past. It was like just couldn't do it.
And for full disclosure, I'm not a shareholder.
No,
just make sure.
Neither am I.
Okay, all right, just making sure.
Yeah, what always amazes me about Monster is that there's so many people out there who on Twitter bring it up, who are not microcap investors, and who would never have invested at it when it was such a tiny little company,
right?
And then always like, oh, I missed it. But you own any microcap stocks now? Like, no. Well, then you would never buy it when it's that small, right? Even if there was a new Monster,
right.
you wouldn't buy it. I think one of the other lessons that I've learned over time that maybe would have applied to Monster is that anytime you exit a stock, try and follow it for another few quarters because there's always the possibility that your sell decision was the error. So that's one of the rules that I always apply to anything I do. I don't. There's a tendency to you sell it and just want to, especially if you took a loss, you never want to see it again, or if it continues to run up, you're I never want to look at it again. And I think you have to put in certain tools to sort of fight that tendency. I will say just special situations is that when it comes to special situations, I consider myself a special needs investor. I have no skill set to do it. But I think sometimes it's and you see that also with concentrated investors. There's certain areas of the market where all the cool kids are, right? I'm a concentrated investor. I do special situations, and it's important to recognize your own skill set or your own abilities. And there's nothing wrong with saying, I'm not a special situation guy, or my approach doesn't work with being concentrated. And even though that's where all the cool kids are these days, is nothing wrong with saying, I'm just going to stick to what I do best. I'm not a special situation guy, but I know a lot of people are going to make great money in it. And God bless them. Well, you
I
kind of
don't know if it's where all the cool kids are.
Okay, yeah. But on average, I'm not a I don't consider myself like a
Jason
typical
sets,
special situation guy.
He sets the trend, okay?
Yeah.
That's what he does. But we got I think we got like 10, 15 minutes left. I know you guys are all busy. You got some things
But
coming up.
one thing just about Mike Madge, just the Expel thing. Like, maybe like the research and like doing the work to see whether like violates the 3M's patents. Maybe that's the difference between like the $1 to $4. But after like $3 or $4, everything else is just like, is this a really good a good business? Do you have conviction, right? It wasn't a special situation after that. So if you look at like $4 up to like close to $80, that's just old school Peter Lynch investing.
I think at the point where there was the lawsuit with 3M is, I mean, you might be able to.
Yeah, I'm just saying that moment there was like special situation, but the great majority of the gain is just went up on Wall Street.
Oh, of course, but you got involved in it right around that time, right? Right around the 3M, the 3M.
Yeah.
I don't know. So.
And for full disclosure, I own some Expel.
Right. I don't.
Me neither.
Did but don't.
Sadly. Yeah. All right. So like I said, I got like 10, 15 minutes. I know you guys are all busy, and we still have I got a couple more questions from Twitter that are really good that maybe we'll get your rapid fire takes here. From Mark Tobin, Coffee MicroCaps. What up, Mark? He asked, are we seeing private equity or private industry competitors come in and starting making takeovers yet happening in microcap tech in Australia? What are you guys saying? Andrew's smiling. I'm going to go Andrew first on that one.
No, that was just a very specific subsegment. Microcap tech in Australia. I can't. I do.
We're very niche here, man. We're very niche.
I've looked at some Australia stocks, especially on the resource side, because that's where a lot of resource names are. I can't really comment on microcap tech in Australia. I was just laughing because of how specific it was.
Jason?
Yeah, I'm not 100%. Maybe he meant that to say like, we're seeing takeovers in microcap tech in Australia. Are you seeing in other markets in other areas too? I can't really. My general tendency is just to stay away from companies that rely on a lot of tech. So I haven't seen it with my names, but I do think it always is a risk in some ways, right? Because sometimes like, the worst thing in the world is like you find a company, you like it, and it doubles, but you think there's so much left in it, and then like PE comes in, swoops and takes it away from you, right?
Yeah.
So it's actually one of the, I think, the great dangers of investing in microcap investing that some of your most promising opportunities are taken away before they really bear a lot of fruit.
Yeah. I was gonna say my quick take on it before I get to Maj on this. Like I think you're speaking specifically right to just microcaps in general in let's just say North America, seeing a little bit of if we're seeing more takeouts or anything like that. There's been a few, but I've seen more business combinations than anything. Especially in healthcare, I think in the last couple weeks.
Just to Jason's point on, I hear so many people who are worried about, what happens if private equity comes and pays a 30% premium to the share price and takes me out before the growth really gets going and that sort of thing. And I absolutely do hear it. And I hear so many people like, I bought this company at 100 EV, private equity bought it for 200 EV, and then they IPO'd it for $1 billion. And look, that would have been a 5X. So absolutely, there is risk there. But I do think there is a lot of survivorship bias where I know a lot of people who private equity firms take out their companies and they are furious. Like I can think of several examples in 2021 where people were like, I'm going to go to appraisal. I'm fighting this as hard as I can. And a lot of those companies, look, maybe they got sucked up in the moment. Maybe the private equity firms ran them really poorly. Like there could be a lot of answers. But a lot of those people, with the benefit of hindsight are like, oh my God, I'm so happy that this private equity company took this off my hands. Like, one, not to dunk on anyone, but At Home Group was a retailer that had a long store footprint to grow, great unit economics. If you think about 2020 and 2021, selling stuff to people for their at home was very popular. I know so many people were involved who were yelling at the company when they sold. There was a huge vote no campaign. They ended up getting a very tiny bump that just got the deal over the finish line. And I think the company's filing for bankruptcy right now. So, it turned out that was very much a COVID boom play. So, I do I definitely hear you. And if you're great at
No,
this,
you're absolutely right, Andrew. You're absolutely right. And a lot of times, but we're investors, right? So we only bitch about the stuff that
hey, you're right. And if you're going for the next great company and you're right, as I said, if it was a 0 or a 10x, well, guess what? If you were right 50% of the time, getting that 10x taken away from you is insane.
I think there's a few names that Maj has in his portfolio that he would love to have PE just come in and take out. Sure. 10% premium.
The candy store is always open. You want to take anything out of 30% premium. The candy store is always open.
There's one stock, they had a takeover offer that they said no to in 2014 at 26. It's $5 now. So to go to your point there. And but yeah, I thought I would see more of it right now. And I don't think we're seeing a lot of the stuff in the space now in microcap land, like the takeovers and mergers and stuff. So, and PE. So I don't know if it's because it's viewed as a riskier environment, but I haven't seen a lot of it. I know over time, I think I've just seen less and less of it happening personally. I thought there'd be given the state of the microcap space, it's just getting harder to invest in it for a lot of people. I would think that a lot of companies don't want to be public anymore. And that private equity could take advantage of that potentially.
For microcaps, especially now, I do think the cost of capital, particularly on the banks failing, to bring it back to the first thing we talked, I think if you're buying $100 million company and you want to get 35 million as loans, I think it's really tough to go find that 35 million as loans. So for a lot of microcaps to exit, even if it makes sense for them to go private, because if you're 200 million or under, I don't know why you're public. The cost of being public is too high, but I do think strategics are really the only game in town for exits currently.
Right. I
just want to say one thing to Andrew's point. I think you look at some other markets. I think Australia may be one of them. I know I've been looking a lot more in the Nordics, like Sweden, for example. They're a little bit more. The cost of being public is not as high as is in the United States, right? And they have like healthier, in some ways, microcap ecosystems. So I think in the future, it will behoove a lot of microcap investors not to only be as focused on the other US or Canada, but to go to other countries like Sweden, where frankly they speak beautiful English and they're very open, and there's a lot of great businesses that emerge from that little neck of the woods. So I think the future of microcap investing is really very international.
I 100% agree with you. I was saying that comment more with a domestic focus, but
I figured as such. Just want to
Europe,
clarify.
I wish our regulations for microcaps were more like Europe, where what is it? Poland has, I think, like 480 different publicly traded video game companies, and the average market cap is like $74 US or something. The latter was a joke, but it's a lot of video game companies. It's just cool that there's so many you can search through and like really do some kind of looking for a diamond in the rough.
100%. All right. So another question here. Two more questions. From Small Cap Value Opportunities at Small Cap Val. Are there any particular industries that you guys are finding quite a few cheap stocks in, and what would be the inflection point that might re-rate them higher? Maj, you want to take that first?
Yeah, I'm not very industry specific. I'm company specific, so I'll invest in it. I mean, I have a company right now in the printing business that is not sexy and not the best industry to be in, and most not doing well in, but it's doing well. So I'm very company specific. So I wouldn't be I don't really invest by industry. I avoid certain industries I don't know about, like whether it's oil and gas and very unpredictable, resources. But I don't think sometimes I like to invest in more the boring industries that no one wants. And then is there a potential for a re-rate in the valuation because they're doing things better, right, in the boring industry? So yeah.
Okay. Well, that's why I came to you first to knock that out. Jason, what do you think?
Actually, I'm going to be echoing Maj a little bit and say that I think at least for myself, it's the focusing on industries is like the wrong way to do microcaps. First of all, like if there's a lot of industry comps for your microcap, then I don't think your microcap's going to be able to succeed very easily. It's really hard. Right. So I find a lot of successful microcap investing is looking for companies where there aren't easy comps, that are hopefully a little bit unique, a little bit different, because you find a microcap that you can look at 6 larger companies or 4 other microcaps, or God forbid, like a mega cap that like they're directly great comps with. then good luck. You better pray.
Andrew, close us out on this one.
Yeah, no, I think I mentioned it earlier. I do agree with a lot of what Jason just said, but right now I think there are a lot of banks that have gone from $500 million market caps to under $250 million market caps, where if you look at the banks, I think all of their metrics look really good. I think they look very cheap. There would be a lot of rationale to some type of merger. And if your forecast is we're going into the Great Depression 2.0, yeah, you probably don't want to buy a single bank because they're all worthless. But if your forecast is mild recession, decent size recession, no recession, like I think you would be very happy buying a lot of these banks that have been cut in half, below tangible book value, nice deposit bases. And I agree with Jason. Especially
I think community banks are probably the exception to the rule. And there's a long history of like very successful like microcap investing in like community banks. But if you just got like ABC Corp, that's like a $70 million company, and it's it makes some widget that competes with a $3 billion company, and even if it's like slightly better, I hate when people are like, oh, this microcap makes a slightly better product. Good luck. Slightly better is never good enough.
For sure. All right, 2 more questions. Before I get to the last question from Twitter, final thoughts. Now that we're midway through 2023. Looking ahead for the rest of your 2023, what are some things you might be looking at? How are you thinking about your portfolio, new idea pull from that bag, when you're thinking ahead, looking at 2023. Maj, I'll come to you first on that.
Yeah, just real short and terse for you, man. Just like I'm doing this, whole GARP, momentum, and that's what I'm really doing right now, and it's working well. And it's what I did for the first 20 years of my career, and it worked really well. And I'm just having a diversified portfolio of, not crazy diversified, but different pockets of, the long-term multi-bagger stuff I thought think is going to do well over time. And it's getting mispriced even more so now in the market. Short-term stuff, working on, this GARP Momo stuff around some more short-term, like special. I don't want to say use waste situation, but special kind of plays where it's like, if I can trade a stock that's a non-dilutive offering that goes down, maybe buy some. The stocks that get crushed in a bad earnings day, building these little other special portfolios around that whole theme. So have a little exposure, but it's all basically all centered around fundamentals, and earnings for me right now is just kind of boring.
Fair enough. Andrew?
Yeah, look, I'm just continuing to do the same research I've always done and try and find interesting things. I do think the world, it's been really interesting. This is a little outside microcaps, but like the VIX and volatility indexes are approaching real lows again. And I just, everywhere I look, I see like lots of volatility in the world, or just, Maj mentioned buying blowups. Like I do feel like we're seeing a lot more stocks report bad earnings or have something come out and the stock gets cut 50%, and just trying to have the work done on it beforehand, to where if the stock goes down 50%, I can incorporate the new news and say, hey, is this a buying opportunity? Or, hey, this is actually really bad, because I'm just seeing a lot more volatility in single stock names that if you do the work before, you can take advantage of. But I'm just kind of surprised by how little volatility is priced in the market.
Very good. Jason?
Yeah, I mean, I think we've it's a pretty, if you're obviously a large cap investor, you're just hoping like, the rest of 2023 continues to be what the first half of 2023 is.
AI 2.0, send NVIDIA and
exactly.
Up another 50%.
Exactly. But for us little people down in microcap land, I think, I have to echo Andrew and Maj, right? I think every year I basically try and do what I've done, variations of one of the previous year. I'm just, looking for more and more, international opportunities, trying to build, even if I can't find an investment, at least find a stock that I can add to the sort of watch list. I think, Robert may have mentioned to you, like I traveled even to Sweden, like about a month or so ago, and met with some companies for the first time, and apologized to any investors I wanted to meet, but I could not meet. And, I'm intending to do that. Right. So just to build out the number of companies I look at, build out the number of countries that have microcaps, and that's really what I'm doing.
Very cool. All right, my final question for you guys before I let y'all go here, and this was probably the most important question that we've gotten that we need to cover from Troy McClure at senior_Troy. Musk versus Zuck in the cage match. Who are you taking? Your quick take. Andrew, you first.
Oh, look, Musk has the size on him, but there's just absolutely no doubt. Zuck has competed in BJJ tournaments. He's been training. If you're doing it any time in the near future and you put any money on Zuck, I actually think it would be like a put all the chips in type scenario, like bet the farm on Zuck. There's no way. The Musk fanboys are going to drive the Musk line up like crazy. I think you could get really good odds on that.
True.
But it would be like, hey, Bobby's been doing BJJ for 20 years. Andrew, you've got 30 pounds on Bobby. You're going to fight him tomorrow. It's like, okay, cool. I'm probably going to die. There's just absolutely...
If it was a boxing match, you got the reach on me. Like, I don't know.
No. I might be. I've never been in a fight in my life. I mean, Musk is like 14 years older than Zuck. He hasn't been training. I remember the photos of him on the boat. Like Zuck is in good shape. He's gonna kill him.
Yeah, I couldn't agree more. Jason?
No, I would. The only Musk I would bet on in the fight is like if Musk's mom took on Zuck, because I think maybe she could beat him. Because I think she's one tough woman. But I would not bet on Elon against Zuck.
I mean, what if it was like no rules? If you could like kick him in the balls, like maybe he's got a shot. But like I don't know otherwise.
Maybe. But under normal circumstances, I bet on you gotta go Zuck.
We need this fight to happen though, because the pay-per-view money, the betting money, all that, it's gonna single-handedly keep the US out of a recession.
First, I think it will arguably, no doubt, be the biggest fight of all time. Like bigger than any Tyson fight, any Ali fight, any what's that schmuck? The one guy who thinks he's a boxer. The Jake, what's his name? I forgot his name.
Jake Paul.
Yeah, Jake Paul fights.
I would love Bezos to like somehow join in, like just to make it like a true cage match. And I think he could take both of them.
Yeah.
What if you put like
one? I would still take Zuck and Elon versus Bezos. I would be tempted to maybe choose Bezos, and I think he's looking pretty good.
There you go. Maj, how are you handicapping this one?
Well, I'm a little out of touch, but with a bigger mouth, I'm not gonna, with Musk, I would not take that, drive the odds up. So I'm taking Zuck, and he's got a little bit of a smirk about him. He's not as loud. And being a nano-cap investor, that's who I'd vote for. And I think as Andrew said, you get really good odds on that probably. And that's my take.
All right, let's leave it there, guys. Thanks so much. Where can everybody go and find more information? Follow you, Andrew. Where can people follow you on Twitter? And,
I write at yetanotherbvalueblog.com, and I have the Yet Another Value podcast, and those are probably the best places to find me.
Very cool. Jason?
You can find me on Twitter at 8track180, or you can find me on MicroCap Club under 8track.
Very cool. Maj?
You can find me at geoinvesting.com, or my Twitter handles at Maj Geoinvesting or at Geoinvesting.
Awesome. Guys, thank you so much. Really appreciate it, and I'll catch up with all of you very soon. Later.
Thanks, Bobby. Thanks, guys.
Podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.